Hello, everyone. My guest today is Garin Hess. He's a serial entrepreneur who's founded multiple software companies, industry conferences, and a nonprofit organization. He's currently the founder and CEO of Consensus, a B2B demo automation platform. He loves reading history, mountain biking, choir conducting, and spending time with his wife and 3 children. Garin, you ready to take us to the top?
Yeah, let's do it.
All right. So automated demo software. This is obviously an interesting space. Talk to us about kind of Consensus. Are you doing any other kind of product lines today or still really focused on automated demos?
No, I mean, it's all about focusing on demo automation. It's such a huge category. I mean, there's 2 main areas that we're focused on. One is pre-sales, meaning sales engineers, and how they service the sales people inside software companies. And just in the sales engineering side, there's a $1.7 billion opportunity, not to mention all of the salespeople that they service. It's been interesting over the last couple of years. We've changed our focus from, I would say we've gained a focus. Early on, we were selling to almost anybody in every use case, marketing, channel, and in the sales, BDRs, AEs, sales engineers. And so now we are hyper-focused on the sales engineering use case. Mm-hmm. And how they can scale that, because there are inherent problems trying to scale highly technical professionals inside these organizations.
And so give us an update. I mean, you came on back on October 8th in 2018. You said you had about 200 customers at that point. How many customers are you at today?
So we're actually at fewer customers, which is somewhat intentional. So we've been going up market, and we're bringing on fewer customers per quarter. And we're having some churn among our small business customers, which was kind of expected, and especially in use cases where it may not be ideal.
Yeah, no, by the way, this makes perfect sense. I'm not hitting the strategy at all. But what are you down to? Are you talking 180 customers now, or what are you at?
Yeah, we're about 175 customers.
Okay. Now, but I would expect ARPU to have increased. So what's kind of average ACV now?
Yeah, average ACV is at about $26,000 per customer.
Yeah. Okay. So that's increased. When you came on last time, that was at about $1,400 a month. Now, you're up at $2,100 a month. Which comes out to $26,000 a year.
Yeah. So that's overall the strategy is working well, and the focus on pre-sales in particular has been exciting because, and again, pre-sales, a lot of people think that's BDRs. That's not what we're talking about. We're talking about sales engineers and how they are constantly having to do these standard demos that really are repetitive, and trying to automate that for them. And that's been a big boon for us, because it's not something that that anyone else is really trying to solve that I know of. And so there are a lot of other platforms that are going after video and marketing, video for sales, and we're really just trying to focus on automating product demos. It's a problem. Tons of companies.
I mean, you told me last time you came on that moving from SMB to enterprise, you felt was harder than even just starting the business. I mean, so you knew this was going to kind of be a challenge, but it sounds like it's working, right? So back then, that was October, you had about 200 customers, $1,400 a month, $280,000 in MRR. Now that profile has changed. 175 customers, higher ARPU at $2,100 a month. MRR now somewhere around $365,000.
Well, like I said in the last one, I'm not going to confirm where we are at with ARR and MRR and ARR, but you can do the numbers. What's interesting is, instead of bringing on customer after customer, we are expanding inside these customers. So we recently closed a deal with SAP, for example, and they started with 4 initial teams, but they have over 500 of these teams inside their company, right? And so it's an interesting question about customers, because in a sense, each one of these teams is a customer, but they're only one logo.
Well, yeah, Garin, I mean, by the way, this is why people just focus on revenue churn and revenue expansion. So, I mean, basically what you're telling me is the cohort that signed up exactly 1 year ago, you're looking at all the cohort, all the customers and all the revenue bands, right, in that cohort. There are some you are intentionally churning off. Let's say that churn, I'm going to make this up, is 50% annually. What you're saying is you now have an upsell muscle where your expansion on the customers you want to keep is so significant, maybe 100%, right, year over year, that net revenue retention is still 150%, because the 100 makes up the 50 you lose, and then you have 100 to add on. So, I mean, by the way, the model makes perfect sense to me. I mean, this is an enterprise, kind of an SMB play moving more enterprise.
Yeah. And like I said, that has been a transition that has, as I said last time, was harder than starting the company in the first place. But what's rewarding is to finally see that we're making progress there. And that's been really exciting to see inside some of these large organizations.
Yeah. I do want to, though, make sure, Garin, I get the trends right. I mean, so you said 175 customers. ARPU has increased now to about $2,100 a month. Is that accurate?
Per customer. Mm-hmm.
Yeah, per customer. Good. Well, and the reason I say that is you kind of said, didn't want to say yes or no to financial numbers, but I'm just I'm basically multiplying $2,100 a month times 175, both numbers you directly gave me. So is there any reason why that multiplication would be any different than what your actual MRR is?
I'm just going to say I'm not going to confirm MRR ARR. It's just not something I do on publicly.
You understand that I'm not asking you to do that. You gave me two numbers, 175 customers and $2,100 in ARPU. And I just confirmed both those numbers with you again. All I'm asking you is describe a case where MRR would not be your ARPU times your number of customers.
So I don't really want to make this conversation about MRR or ARR. Is there something more meaningful that we could move on to?
Well, you may have revenue streams that are not tied to customers this way, but typically the way you calculate ARR or MRR is by taking an ARPU times the customer count. So the reason I'm pushing this question is because you might have a lesson to teach us if you have a different revenue stream that is not a SaaS revenue stream that is tied to this, which might make your revenue different than that number.
Yeah, I guess what I'm saying is I'm not interested in talking about revenue as part of that's not my main objective for being on the podcast. I want to talk about meaningful, not that revenue isn't meaningful.
Yeah, Garin, by the way, no offense. I've done like 1,000 of these. So my job is to make sure my audience gets value, not that you get what you want from the show. My hope is I can align them, right? So that's my job, is to try and figure out an alignment of the two. So go ahead. You tell me what you want to get out of the show, and I'll try and figure out a way to make them overlap.
Well, I want to provide value as well. I just don't think the MRR and ARR provide the most value. I think what provides the most value is discussing the problems that the industry is facing that we're trying to solve, and talking about the customers and the challenges that they're facing and how our unique solution can help solve that. I think that's what provides.
Well, it's not right. This isn't a sales call, right? All my people listening right now are also like you. They are entrepreneurs that are doing this own math in their own companies, and understanding how you're doing your math is what's valuable to them. Now, yes, they're going to understand your product at the same time, and they may turn to customers as well. So, I mean, look, we'll move on from this, and I'll try and question where there's value on both sides. But it's very weird to me that you'd be cagey on giving those two numbers around ARPU and customer count and then have them not equal MRR. It makes me feel like something's up and I'm doing a bad job asking the right questions. With that said, we'll move on. So you made the tactic kind of go downstream. One thing you did leverage in the business to help drive growth, which I love because you're able to hold more of the company, and I want to see founders own more equity. You told me last time you worked with a venture debt from recurring revenue partners. Has that continued to play out how you expected it to play out?
In what way?
Well, I don't know. How'd you expect it to play out?
Is it a question about, is it a good decision? I definitely think it is. The venture debt partners that we worked with have been really great team contributors, and have actually come up with creative ways to help address certain financing situations, and they've got good rates and things like that. So in that sense, yeah, I don't have any concerns at all. So I would highly recommend them. I don't know if I mentioned the firm, but Riverside Acceleration Capital is the firm that we work with, and they're fantastic. So Jim Toth over there is awesome.
Oh, I thought you said Riverside Capital. That's my fault. You worked with Riverside Capital. Riverside
Acceleration Capital. So Riverside is a huge holding company. They've got an arm that does venture debt.
Okay. Yeah, no. I mean, I guess what I would tell you, there's a lot of founders. I get questions like this all the time on the blog where it's very difficult for people to compare the true cost of venture debt to the true cost of equity, because they're very different instruments, right? Sometimes you can get in a tough spot with debt, especially if there's kind of covenants and warrants built in. And even if it's just a 3 to 6% of gross monthly receipts you're paying back on a 3-year term at 1.3x repayment cap, that can get really expensive if you grow and pay it back in a year instead of 3 years. So it's hard to kind of normalize between the two. You've done both, right? So I guess what I'm asking you is, if you're optimizing for preserving your own equity and everyone else's equity in the company that you've given equity to, do you feel like you can keep growing the company solely using venture debt?
I think at some point we're probably going to add additional venture capital equity rounds of financing, but I I really do love the way that it's worked so far. We end up having a multi-year term. The servicing the debt has not been a burden, and we've done kind of this bifurcated model where we have some percentage of cash receipts plus some a flat amount. So they gave us a choice when we signed on to it. Do you want to do just flat repayment amount every month, or do you want to do a variable amount based on cash receipts? And we said, how about a mix of both? So we have some discipline built in with the flat amount, and we have this variable component added to it. And that's worked out really well for us, and no surprises there. And it hasn't turned out to be an unexpected burden or anything like that where I would not recommend it to people. I highly recommend it. I think the place for it is when you are unsure about where your inflection point is going to happen, and if you take on equity at the wrong time, you might be giving away too much of that equity, or take on equity financing prematurely, where you can use that to grow the business and then take on the equity financing, once you've gained some additional ground there.
Have you raised any additional since the last call?
You
said 7. No. Yeah, you said 7 million.
No.
Okay, so you're still at 7 million all in debt plus equity.
Did I say 7 million last time? Because I would say,
yeah, I have the quote.
Guess that we have 9 million or so total, but we haven't raised any since then. So maybe I'm
yeah, no, I have the quote here. You said 7, and maybe at the same time or something, you brought another 2 or something. But okay, there's 9 in the company total to date.
Yeah.
Okay. When you do the bifurcated model where it's a blend of fixed plus percentage of cash receipts monthly, is the flat part, is it truly fixed, or is it actually tied to prime plus 100 basis points or 150 basis points or something on top of prime?
No, it's just truly fixed. So there's a fixed multiple payout, right? So we took on X capital, and then we have to pay back so much over a certain amount over a certain period. So it's and they just took they took half of that amount and just spread it across the years that we're committed to pay. So we have a 5-year payout period, and so half of that every monthly payment is a fixed amount, and half is variable, or not exactly half, but it's split up.
Yeah, I guess what I'm saying, a lot of these folks that do strictly fixed term where there's no blended, it's not actually fixed. It's tied to prime. And so, for example, if interest rates increase, you're potentially, or anyone that is raised tied to prime is not in maybe a good spot, but the bank are protected because it's tied to prime. So that's what I'm asking you, is it prime plus something, or no, it's flat?
Yeah, it's specifically a multiple of the original amount. Yeah.
I'm talking about the interest. So it's a percent, like, I understand you're talking, I think, about repayment cap.
Monthly payment.
Yeah, so so typically these kinds of things are either recurring revenue-based financing or it's a term-based loan. Both pay periods can be anywhere between 2.
Revenue-based financing.
Well, you said there's a component that's fixed.
Yeah, so let's say you buy $1 million. You have a 1 point, and you might have a $2 million payout over 5 years. So it's a fixed payout over a certain period, and if you happen to reach it sooner because the variable amount gets up there, then you end up paying it off early. But the fixed amount of the bifurcated model is just a flat amount every month, and then there's a variable amount. I don't know if that makes sense, but
yeah, no, that's helpful. I understand.
There's a fixed total payout, but it's not based on a prime rate or anything like that.
Yeah, no, I got it. Thanks for clarifying that. That's great.
Yeah.
You've changed your customer mix. Has that affected? I mean, obviously you've gone into your historical cohorts, doubled down on driving expansion on customers you want to keep. What have you done to bring on brand new customers that are the ones that you want to keep, the higher ACVs, things like that? In other words, have you changed your inside sales model or anything like that?
Yeah, quite a bit. Because we're going after a specific, a more narrow segment, we decided to just leverage a lot more LinkedIn than we have in the past. And that's been working well. We actually started experimenting with LinkedIn ads. So we do a lot of LinkedIn outreach, just like a lot of people. But we do a mix of that kind of just targeted outreach to specific contacts within specific companies, as well as we started working on ads targeted I love that LinkedIn lets you show ads to very, very specific roles within specific companies and so on. And so you get a mix of just sort of the typical outbound approach to, and then some quasi inbound. When I think of inbound, I don't think of ads as much as I think of sort of organic searching, but I still throw ads in inbound, and that's worked really well. That mix so far. We're still playing around with it, but yeah, I just had a call this morning with a great mid-market software company based in Spain that found us through a LinkedIn ad, watched the interactive demo, and 3 different stakeholders were on that call, and so that's one of the main ways that we're going about it right now.
So when you look at kind of your fully weighted CAC with this new model, right, higher price points, using your own technology, obviously, plus the LinkedIn aspect of this, I mean, what are you willing to spend to get a new $25,000 first year customer? Will you spend first year ACV to get the customer?
Yeah, generally speaking, I think that's a good rule of thumb, is to spend as much as, and maybe even go beyond that. But I generally don't like to go beyond that. Right now, our CAC's at around 18.5. Mm-hmm. So it's a good ratio. Years ago, we had about an 18-month CAC payback period with new customer acquisition. And now it's less than a year. So that's a good thing. But yeah, I would be willing to spend up to that amount on average to bring on a customer.
Yeah, just to be clear, you'll spend $18,500 to get a new, call it $25,000 a year customer. So your payback period there is about 9 months, under a year.
Right.
Yeah, that's great. Very good. All right, Garin, let's wrap up with the famous 5. Number 1, what's your favorite business book?
Favorite business book is The One Thing by Gary Keller. If you asked us last time, that was probably the same.
Number 2 is there.
I've got some new ones. I'm right in the middle of the Steve Jobs biography. I can't say it's my favorite business book, but it's an awesome biography. Which
number 2, is there a CEO you're following or studying?
Again, Steve Jobs. Right now, that would be the one I'm thinking a lot about.
Number 3, what's your favorite online tool for building your company?
Online tool?
Yep.
So I'm going to give a shout out to a company called the ROI Shop. So this is an online ROI calculator software run by a guy named Michael Farber, and it lets you sort of build ROI calculations with your customer and then send them a link where they can play around with ROI themselves as well. So we've been really finding some good success with that.
Yeah, that's great. They're now serving over 50 customers at about $500 a month, doing about $30,000 a month in revenue. Michael came on the show back. That would have been about a year ago now. A lot of people saying nice things about that. So that's good to hear. Yeah, good. Number 4, how many hours of sleep are you getting every night?
5.
Okay. And situation, married, single, kiddos?
No, it's just, I've dealt with sleep maintenance insomnia for a lot of years. It's basically I can fall asleep at any time, but when I wake up, I'm fully awake. So
yeah.
If I wake up at 3 a.m., I may as well not try to go back to sleep. So
next question: what's your situation? Married, single, kiddos?
Yeah, married. Yep, have kids, 3 kids.
3. I got your hands full. And how old are you, Garin?
I am 49.
Last question: what do you wish your 20-year-old self knew?
I wish my 20-year-old self knew that. It's always a tough question, but I would say, don't sweat the small stuff. And don't worry too much about what comes in the future. Focus on today and enjoy the journey. I mean, that's kind of cliche, but it's the reason it's cliche is because it's so important, I think.
Guys, Garin interactive demo software, goconsensus.com, now serving 175 customers at about $2,100 per month. Call it $360 a month in revenue, up obviously from when he came on about 6 months ago. Economically wise, again, moving more upstream. So less customers, higher ARPU, spending about $18,500 to get a new $25,000 a year customer, 9-month payback period, still about $9 million raised, effectively using venture debt, which is nice. You preserve equity there. Garin, thank you for taking us to the top.
Yeah, thank you so much, Nathan.